Imagine checking your phone before sunrise, half asleep, coffee not even brewed yet, and seeing a number that makes you sit up straight. Silver just pushed back above $62 an ounce. Just days earlier, it had been sliding, touching its lowest levels in 7 months, and plenty of people who owned it were starting to feel uneasy. Then, almost overnight, it snapped back with real force. If you were one of those people wondering whether you should have sold, or whether you missed your chance to buy the dip, you are far from alone. And if you weren't watching silver at all, this is exactly the kind of moment that tends to get investors' attention only after the move has already happened. Here's what makes this particular bounce worth paying attention to. It didn't happen in a vacuum. It happened right after a piece of economic data landed that was much weaker than almost anyone expected. The government's jobs report showed the U.S. economy added far fewer positions last month than forecasters had predicted, and previous months got revised down too. That might sound like dry economic trivia, but weak job growth changes how investors think about interest rates, and interest rates are one of the biggest forces behind precious metal prices. When the job market cools faster than expected, it becomes less likely that the Federal Reserve will need to raise rates to fight inflation. And lower rate expectations tend to make non-yielding assets like silver and gold more attractive. That's a piece of the puzzle most headlines skip right past. Before we go further, if you're finding this kind of explanation useful, take a second to like this video and subscribe to Smart OG John Ag. It genuinely helps more people discover level-headed educational breakdowns of what's actually moving these markets, instead of just noise and price alerts. Now here's what most investors never realize about a move like this one. A single day's rally, even a strong one, rarely tells the whole story. Silver had already fallen more than 15% over the prior month before this bounce, so a 2 or 3% single-day jump, while exciting, still leaves it well below where it was trading not long ago. Yet it's also true that silver remains dramatically higher than it was a year earlier, up by well over 60% according to recent market data. That combination, a rough month layered on top of a spectacular year, is exactly the kind of setup that creates emotional whiplash for everyday investors. Some people see the drop and panic. Others see the bounce and chase it. Both reactions are understandable, and both can be costly if they're not grounded in a bigger picture. Let's talk about why silver behaves this way in the first place, because understanding this is the difference between reacting to headlines and actually understanding the market. Gold is often called a safe haven, something people buy when they're nervous about the economy or the dollar. Silver shares some of that safe haven appeal, but it also has a foot firmly planted in the industrial world. It's used in solar panels, electronics, and medical equipment, which means silver's price isn't just about fear or comfort. It's also tied to how factories and manufacturers are actually using the metal in the real economy. That dual identity is part of why silver tends to swing harder than gold in both directions. When optimism about growth rises, industrial demand expectations can lift silver even faster than gold. When fear about growth rises, that same industrial link can work against it. Most people only think of silver as cheaper gold, but that framing misses why it moves the way it does. There's another reason the market may be reacting the way it has this week. Comments from the Federal Reserve's chair acknowledged that inflation expectations have been easing, while still emphasizing a commitment to keeping prices stable. Markets pay extremely close attention to this kind of language because central bank officials rarely say anything by accident. When a Fed chair signals that inflation pressure might be cooling without promising anything specific, traders start adjusting their bets on future rate moves almost immediately. That shift in expectations can ripple through currencies, bond yields, and yes, precious metals, often within hours. Picture a retiree named Linda, not a real person, just a relatable example many viewers might recognize themselves in. She bought some silver a few years ago as a way to diversify her retirement savings beyond stocks and bonds. When she saw prices sink toward 7-month lows recently, her instinct was to check her account daily, feeling that familiar tightness in her chest that comes with watching a position move against you. Then, within the same week, the bounce happened. and suddenly the emotional pressure flipped from anxiety to relief. Here's the part that changes everything for someone like Linda, or for you. The asset itself didn't change. The economic story around it shifted, interpretations of Fed policy shifted, and short-term trader psychology shifted. Long-term investors who understand that volatility is simply part of how silver behaves tend to make very different decisions than those who are reacting purely to the last 24 hours of price action. What happens next may surprise you, because it's rarely a straight line. Historically, silver has moved through long stretches of relatively flat or even disappointing performance, followed by sudden, sharp rallies that can catch even experienced investors off guard. Over the past century, silver has actually underperformed the broader stock market by a wide margin when measured across long stretches of time. That's not meant to discourage anyone from holding it. It's meant to reframe what silver is generally used for by disciplined investors. It tends to work best as a smaller piece of a diversified portfolio, a hedge against inflation and currency weakness, rather than a primary engine for long-term growth. The market often rewards those who understand this difference between what an asset is good at and what it isn't designed to do. Later, we'll look at one signal that many everyday investors completely overlook, so keep that in mind as we continue. Let's talk about the US dollar for a moment, because it's deeply connected to everything we've just discussed. When the dollar weakens, it generally takes fewer dollars to buy the same ounce of silver or gold, which tends to support prices. Recent data has shown some softening in the dollar alongside these shifting rate expectations, and that softening removes some of the opportunity cost of holding precious metals instead of interest-bearing assets. This is one of those behind-the-headlines connections that rarely gets explained clearly, yet it quietly influences precious metals prices almost every single day. Here's the signal many investors overlook. It's not just the price of silver itself, but the relationship between gold and silver prices, sometimes called the gold-to-silver ratio. This ratio tells you how many ounces of silver it takes to equal the value of 1 ounce of gold. When that ratio compresses, meaning silver starts catching up to gold's performance, it often reflects rising confidence in industrial demand or a shift in investor appetite toward the more volatile metal. Watching how that ratio moves over weeks and months can offer a clearer picture of market sentiment than watching the daily price of silver alone. Most headlines focus on one story, the raw price, while the real signal may be somewhere else entirely. If you're someone who owns silver, or you're thinking about starting a position, there are a few practical habits that experienced, long-term investors tend to rely on. First, they avoid making large decisions based on a single day's price action, whether that's a scary drop or an exciting bounce. Second, they pay attention to the reasons behind a move, not just the move itself, because understanding the why helps you judge whether a trend has real staying power. Third, they think about position sizing, treating precious metals as one piece of a broader financial picture rather than an all-or-nothing bet. And finally, they stay aware that markets can remain volatile for extended periods, even when the long-term investment case still makes sense to them personally. As we wrap up the core ideas here, let's bring it all together. Silver's recent bounce above $62 didn't come out of nowhere. It followed a weaker-than-expected jobs report, shifting expectations about the Federal Reserve's next moves, comments from Fed leadership about easing inflation pressure, and a softer US dollar, all layering together at once. At the same time, silver remains well below its levels from a month ago, even after this rebound, which is a reminder that short-term price swings don't always tell the full story on their own. Understanding the connective tissue between jobs data, Fed policy, the dollar, and industrial demand gives you a far more complete picture than simply watching a ticker bounce up and down. I'm curious what your own take is on all of this. If you already own gold or silver, how are you approaching this kind of volatility? Are you someone who watches the Fed closely, or do you pay more attention to the price chart itself? Drop a comment and share which signal you personally watch most closely when precious metals start moving like this. Conversations like that are genuinely one of the best parts of building a community around thoughtful investing. If you found this breakdown helpful, consider sharing it with a friend or family member who's curious about silver, gold, or how the Fed actually influences the markets we all watch. Financial education tends to spread best person to person, and someone in your life might really benefit from seeing the bigger picture laid out this clearly. Markets will keep doing what markets do, moving on data, emotion, policy, and time. The investors who tend to do best over the long run aren't the ones who predict every twist perfectly. They're the ones who stay patient, keep learning, and make decisions rooted in their own research and their own goals rather than headlines or hype. Thank you for spending this time with Smart OG John Ag today. Keep asking questions, keep digging beneath the surface, and remember that every investment decision you make should ultimately reflect what's right for your own situation and your own financial future.